Hi guys, so welcome to day 12 of this training. So we are officially more than 50%, right? So we have about let's say 11 days to go. Right? After today, then we're left with 10 days, right? So in today's teaching, we are going to be talking more about liquidity. So today, the purpose of today's teaching is to teach you guys more about engineered liquidity, right? Engineered liquidity. So once you guys understand this, right? When I talk about engineered liquidity, I'm referring to inducements, right? Inducements. So this topic is very, very crucial because it will help you know when a break of structure is not really a break of structure, right? You know, one limitation or one problem with inducement is that sometimes some people would call a break of structure an inducement, or they will call an inducement a break of structure, right? So most times when the market is printing, let me get trading view. All right, so most times when the market is printing some kind of price action, it tends to form some kind of inducements. Let me show you what I'm talking about so you can understand. I have to show you guys quickly with the real charts what I'm trying to say. So inducements form almost every time in the market. Why that's good? So most times, if the market is bullish, we tend to see some kind of inducement, right? So if you see the market is creating bullishness, the market makes some kind of inducement and then does this and then blast off. Now, this thing you see here is what we refer to as an inducement, right? This engineered liquidity. Now, why the market does this is that you would have the original POI below, right? You have the original POI below, and despite the original POI being below, the market is still going to create some kind of let's say trap for people to get in early, right? Assuming that maybe we have, let's say, a key level here, maybe a kind of key level at this point here, maybe an imbalance or something here, right? At this point here. So most times the market is going to create some kind of inducement to make people to buy before price comes there. So people that are always in a hurry to take a trade, when they see this movement, they will do what? They will treat this point as what? A double what? Bottom, right? So there's a certain price to come there and then continue. So maybe price will come here and then continue. Meanwhile, the original intent of price is to engineer liquidity. So you can see why the term, how the term came. How the term came, right? The term came by the market engineering. Engineering means to design, right? You can call it design liquidity, all right? All right. You can call it engineer liquidity. You can call it a trap or a smart money trap. Some people call it smart money trap. You can call it smart money trap. So they are going to see this low as a point of an order block or something that they can take a buy from. And then what happens, the market smashes the original POI and then what? Continues bullish. Now, the funny thing about this is that those people that were buying this will take a loss. And then there are some people that would think that this is a break of structure. So they would like maybe target this other block here for a sell. And they can see that they're also taking a loss. So inducement takes out both buyers and sellers. So whenever an inducement is formed, you have to be very, very careful because it could take out those that are buying and then take out those that are selling. So it's one of the ways in which the market takes money from retail traders, right? This is one of the ways the market take money from retail traders. Now, the issue is that sometimes this thing you see here might be an original break of structure. So you will now maybe thinking that it's going to continue buying, and then price does something like this. It will tap here and then drop down. So you have to also be mindful of that. So sometimes price can, create the real break of structure, and then it's looking like an inducement, right? So in this teaching, I'm going to try to help you to understand when an inducement is formed and when a real break is formed, right? So now, in my opinion, One of the ways that you can tell that, okay, this is a break of structure, this is an inducement, is by looking at where price is coming from, right? And then looking at the trend of the market, right? So now, if you look at the overall trend of the market, so these are the things you look out for. You look at the trend of the market, right? Is it overall bullish, right? And then where price is what's coming from. Where is price coming from? Right? Where is price coming from? You have to be very mindful of that, right? Because if price is coming from a major key level, right? Let's assume that there's a major key level here. It's kind of big higher time frame key level here, right? This is likely going to be what a real break of structure, because this is a higher time frame what point of interest, or higher time frame what key level. But most times, if there is no key level here and price is even coming from a bullish POI, right? A kind of bullish POI, then you can classify this as what an inducement for price to go long. So one of the ways you have to look, one of the ways you fit out inducement is by looking at where price is coming from. Is price coming from a key level? Has price taking liquidity? So another example now, assume that maybe we have some kind of liquidity resting here, and then price breaks through the liquidity, like price taps through the liquidity. Maybe it's a kind of liquidity resting here, a kind of higher time frame liquidity there. And then price does what? Price breaches that liquidity point, maybe some kind of equal high or something. So price takes other liquidity and then does this. Most times, this is going to be what? A break of structure. So the thing that really changes price direction, there are two things, right? Number one is a key level. These are the two things that really changes price direction, right? Key level, and then what? A run of liquidity, right? So that things that really changes price direction. So when price hits a key level or it runs liquidity, right? It takes out higher time frame liquidity, maybe 1 hour liquidity or a point of liquidity, and then you cannot trust this. So one of the ways you actually trust a break of structure that it's not an inducement is that you want to see price tap into what a key level, such as what an imbalance, such as what an order block, such as what an imbalance, an open close key level, such as a breaker block, all those higher time frame reasons, such as what a key level, right? A higher time frame key level, maybe a higher time frame demand or supply zone. All right, so those are the things that really make price to reverse, right? So you have to be very mindful of that, very mindful of that, very mindful of that. All right, you have to be mindful of that, because it's going to really what help you. Right, look at this now. For instance, look at what we're talking about here. So you can see how EUSD was dropping. Now, some might have considered this was a break of structure, because my price went above this high. But what happened? Price was still dropping, continue what is drop, right? So you can see that that is one of the things we are talking about. So sometimes price does things like this, especially when price has what a target to the downside, right? Maybe there's some kind of, let's assume that maybe there's some kind of higher time frame liquidity zone here. So if you have a higher time frame liquidity zone here, right, and price does this break here, what is the likelihood that this is going to hold? So these are the things you have to think about. Trading is all about, you have to think, you have to go beyond just pattern, just okay, it's a pattern, it's a break of structure. You have to always think logically. If you have a reason why price should come down there, right, and then you see what a bullish break here, right, you know that the market is likely going to continue downwards. This should have been seen was what an inducement and what a run of liquidity for what a continuation or to the downside. All right. So you have to understand. I want to also show you guys a very good example on the higher time frame. Let's see. Let's use the higher time frame to really talk about this in more details. All right. Let's use the higher time frame to talk about this. All right. So now watch this. Watch this. Watch this. Watch this. So look at what happened on the H4. Right. Market was bullish here. Look at Euro. This is the bullish market. So if you watch this very carefully, you can see that the last pullback before this break happened there. So let us understand this particular market structure, right? You can see that the market has been properly mitigating down here. The market. Just watch this. Watch this. We saw this pull down, right? Markets went above this pullback, like it went down. Then markets came, tapped in there, and then moved above, and then we had this as well. I had this area. Look at this. So this pullback, right? Watch this. Let me explain this very well. I can understand what I'm talking about. Now watch this. Let me start again. So we had this last order flow. Watch my video order flow. I talked about order flow in the earlier part of this teaching. So price went above this order flow and then came back. So this 4-hour return was a return towards mitigate the order flow. So had a net order flow here because after this happened, we made it was a new break to the upside. So markets came back again, mitigated this order flow as well. So what do we have again? We have another so we had another pullback, see another one here. Price came, then mitigated it. So this was where the last order flow happened. So if you watch carefully, price came, this is what price started coming down from. So mark the points where price started coming down from, right? So like I said, price started coming down from here and then came down here. So now this was our last area of order flow, which has not been tapped into, right? So we're in a very bullish market, right? So in a bullish market based on what? The order flow. And then if you take out your Fibonacci tool and try to get a discount of premium level, you will see that from here to here we are in a good discount level. All right, now watch what happened there. Price came, tapped a bit into the order flow, but look at what it left. It left this imbalance here, right? And this imbalance was where at the 62% Fibonacci level area. So I've told you guys about ICT OTE levels. So what do you have there? This is the bodies of the candles. Right. So what do you have here? We had this 60% level, which has not been tapped into, which was a major level on the Fibonacci tool. Right. And then if you look inside, we had this imbalance that was inside this order flow. So we had an imbalance here, right, which was not properly filled. Right. And you can note something too, that this low, right, it failed to break a new high. So this low here was not strong enough to break and make a new high. So what the price do? Price created this inducement just above this imbalance, only for price to come back there in the future and continue its rally to the upside. So you can see how inducements are formed, right? So this inducement was formed just before this imbalance, which was inside this bullish order flow here. I took out the box so you can see what I'm talking about, right? So it's formed inside that, but this is a gun box. So it formed inside that spot there. This is a gun box, so you can get that 50% as well. So you can see how price came down to that 62% level. Filled this imbalance? When I say filled this imbalance, it filled this imbalance properly, and then was rallied to the upside, right? So that is how these things occur. This is how these things occur, right? This is how these things occur. Now, imagine that you want to buy this. Remember, I told you guys that once price takes liquidity, that is a bad sign to continue buying, right? So you can see as price took out this liquidity area here, right? It took out this liquidity point there. What happened? If you are trying to buy this, you would have likely taken a loss because why? Now the market itself was giving signs of bearishness. As the market broke this, it made an imbalance, right? It made an imbalance. And what's happened next? Inside this imbalance, we had this other block here. So this other block low was tested and then price was dropped down. So you can actually tell us other blocks that created when price runs liquidity. Don't worry, I'll teach you guys about high probability other blocks, right? So high probability other blocks, I'll go into details when other block is valid and when it's not valid. Don't worry about that. I'll teach you guys about that. So price made this other block after it has run this forward liquidity. And what happened? Price came, tapped into it, and then gave up the ghost. So I think this was on NFP. This was an NFP day, right? This was NFP or something, right? I think it was NFP. This was on 7th, yeah, NFP. So price came and then what happened? Dropped like hot beans. All right. So this is basically how these things occur, right? So inducements are formed before original POIs, especially when price has not balanced something of interest, right? So let's just see if you can see something on the Nasdaq. Let's see. Nasdaq is always very functional on the lower time frame. So let's see if you can see something on the lower time frame. Okay, let's use yesterday's price action. So what do we have here? Market is bullish, right? So we saw our high, our low, and then what? Market was in the bullish range, right? We're in a bullish range, right? So watch what happened there. So this market came down, it failed to go below this low, and then we saw a kind of market total shift here because price went above was this particular swing high here, right? So there's kind of swing high here, which price broke above. Now watch carefully. This other block was left untapped, like 6 other block there. Price just tapped it shallowly, right? It tapped it shallowly. And what happened? It's tapped the other block shallowly. It was not a deep one. And then price was came back down properly to mitigate this other block properly, right? Taking out this as an inducement and then was rallying what to the upside, right? This things happen a lot. These things happen a lot. It happens a lot. Whenever you see price run liquidity and then what continue what to that overall what direction. This happens mostly when there's something towards mitigate. There's a reason why price is coming to that spot, right? So I'm very, very mindful of what price is doing, right? I'm very mindful of that. So let us not just label this. Now let us just label this. So let's talk about the ABC trading pattern, right? So now we have understood a bit about this inducement. So what we call an ABC pattern. So this ABC pattern simply states that when the market is moving, we have what something like this. Or let's do it this way. Right, this is what we call the ABC trading pattern. So we have some kind of run of liquidity, creating a strong low, and then we have a bullish break to the upside. We have our B, and then so this is what we're trying to say. We're trying to say that whenever price is bullish, we tend to see this kind of setup form a lot. So now what happens is we see price creates this leg, right? See price create this leg by this impulsive run, right? We see price create the A leg, we see price create the B leg, and then we see price create the C leg, right? The labeling is not important, so you can do it anyhow you want. You can see even say A, B, C, D, E. And some people call it A, B, C, D, E. Like they will do A, B, C, D, and E. But just for this example, or let's make it in the way I know. So this is your A leg. This is what the original was strong low. This is your B leg, where the retracement started, and this is your C leg, where the inducement was formed. So what do you expect the market to do? We expect price to always take out this C leg, which is what the inducement, and then what rally what to the upside. So this is one of some people A plus setup. Right? Some people use this as an A plus trading setup. They want to see the market create an inducement leg just before their POI, and then do what they take price to the upside. Right now, this area, there are different ways you can trade this. Number one, you can take this trade off the QM arrow level. This happens to be your QM arrow level, your Quasimodo reversal level, right? You can take a trade from this point here, or you can take it from what? This lower order block here, right? But for conservative purposes, or to be conservative, regardless of where you're taking your trade, your stop loss has to be below the low. So even if you're taking it from this point here, right, your stop loss has to always be what? Below this low, just for conservative purposes, because price can choose to reject from here and then come lower to this what? To this area down here. So some people call it the ABC trading pattern, right? So that is what it's simply about. So whenever someone say ABC trading pattern, the person is simply referring to what? Internal liquidity, which is called what? Engineer liquidity, right? And then note this, that price doesn't always look like this. So price can also do something like this. It can create a series of inducements, right? Price can also create what we call a series of inducements. It's not just it must be one, right? It's just the pattern, just for you to understand, right? Market does not always create that way. So now you can look like this. So market do something like this, and then it take out these two liquidity points, then come back and then run up. So also we know that so market can create a series of liquidity, right? Series of internal liquidity, and then your eye should always go for the last inducement. So whenever you're filtering inducement, always look at the last one. So this is the one you really pay attention to, not this one up here, right? Always pay attention to what the extreme inducement, this one here. Right? This is what you're really paying attention to, this particular one there, right? So when price takes it out, it can. But sometimes price can still choose to take out this up one, then just buy from here. Right? It happens too, right? You have to just be flexible. This also happens. So price can do something like this. Take out this first inducement up there, and then do what? Shoot up. But for your A plus setup, want to see price what? Run the very last liquidity, and then tap your strong low. What is a strong low? Remember I told you guys a strong low is a low that runs liquidity before breaking above. What do I mean? This low ran the previous low before they was breaking above. Meanwhile, this low did not run out any low. This did not run out any low, but this particular one ran out what this low, right? Can you see that? So that is why we always pay attention to what this one, because why it ran with this low. So this low ran out the previous low before they was breaking above. Meanwhile, this one did not run out any low, just bullish pushes, right? So that's what makes this a strong low. Strong low is that extreme low that was runs liquidity before they was breaking toward the upside. That's why how you pay attention. So this was called the ABC pattern. And of course, when you're talking about the bearish perspective of it, it's just the reverse. So price has to, run liquidity and then give you that inducement, and then was your original what tap and then was drop off. So in this scenario, you can also choose to use the KMR level, which is what this is a KMR level, this spot here. So this happens to be a KMR level, this spot here. So I choose as the entry, and of course, even if you choose this or maybe you choose another block, whatever you choose here. But some people even choose a breaker block, which is down here. So this one works a lot with lower time frame confirmation. So if you choose a breaker, you choose a KMR, you choose a break, or whatever you choose, whatever that is ready for you, right? You simply do what? You simply wait for a confirmation, and then your stop loss should be what above this high, right? Just because of it, your stop loss should be what above this swing high here. So it's very easy to trade, right? So that's where we'll be wrapping this call. So if you actually learned something in this video, just type I got something. I got something. If you got anything at all in this training, it's just type I got something. I got something. I got something. Right. Let me just look for one random pair. Let's look at J30, or let's also use German 40. All right, so this one other markets indices. Okay, so let's look at German 40 and see if something is there. Sorry, my. So what do we have here? Let's go to the 30-minute chart. I want the lower time frame something, right? So I want the lower time frame stuff. I don't have to talk too much. All right, so okay, so watch this market. So what do we have here? Okay, right. So what do we have here? 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 Juventus has really been in a sideways direction. Has not really been, giving those clean setups. Right, so yeah, I can see something here. So what do we have here? We had what? A strong low. So a strong high. What happened? Why? This high, why is it a strong high? Remember I told you. It took out liquidity before breaking what? Downwards, right? So remember again that we had what an inducement. That's my inducement. This one here, right? That's our inducement, right? And then you can see how there's some imbalance even above. So this imbalance was a very clear sign that this is an inducement, right? Inducements don't always fill imbalances. They always leave imbalances, right? You always see market make some imbalances when inducements are formed, right? So let's say if you took your trade off the KMR level, so maybe if you took your trade off this KMR level here, right? Maybe this would have been your trade, maybe at the KMR level there. Although price kind of shot up a bit, but these things happen, right? It happens. So you are maybe you have caught yourself here. I'm not looking for perfect examples. I'm not looking for you to understand the whole idea. So if maybe you used to put your stop loss a bit above a high, right? That's why it's always good to put your stop loss maybe one or few points above, right? If you maybe put your stop loss few points above this, would have not been taken out. It's always good to put your stop loss few points above a POI, or you wait for confirmation. So if you are waiting for confirmation here, I don't think could have had it yet. So you would have waited for a confirmation for price, would have done its thing. All right. So let's look at another one. Look at another one. Yes, market was bearish as well. What can we see here? Also a bearish market. This is our strong high because this high took a liquidity. We have what our inducements. This is our inducement right there. Right, these are the inducements. All right. If you take a flip tool and draw from this swing high, right, from this swing high there down to this swing, you can see that this is actually what we call discount level. The price came over discount our premium level, which is an area of interest, and then what do we hit? think we hit this breaker block here. This is a breaker block. Right? You hit this breaker block there, and then this breaker block aligned with this imbalance there, which was at the above 50% range, right? So if maybe we're waiting for a confirmation here, maybe we would have seen it, right? But ideally, normally I just like to see price come for the last inducement. And where is last inducement? Here, but the price chose not to come this far. This would have been the last inducement, right? But price they choose not to. So always knows that too. Once price comes to 50% of your range, then sometimes price wouldn't really get to where you want to get. So always note what discount and premium levels. I've taught you guys this thing before, right? Always note the 50% of your trading range because it will help you if in case in situations where price does not intend to come to the original last low, right? It doesn't want to come to that last low, right? So you have to be mindful of that. So I think that is basically what I can say. Market has just been very impulsive, right? It's just market has been crazy, like it's been really, really crazy, right? All right, I've seen another good example here. So watch this, watch this, watch this, watch this. So this is an example where price came for the last inducement. So where's our last inducement here? This right, this is our last inducement. Can you see that? This is our very last inducement, right? What do we have here? You can see that this high took our liquidity, which will make it what a strong high, right? And then you can see all these inducements here. 1, 2, 3. You can see our price took out all these inducements, and took out the very last one, tapped what that strong high low was. It dropped off to make what a new low. Right. This is this is what we call an A plus setup. This is an A plus because price came for the very last inducement. Right. That's what I've told you guys. But I've told you as well that sometimes price doesn't do that. So how do you approach such scenarios? Just simply do what? Bring out your Fibonacci tool. Just bring out your guidance box. Take out a 50% measurement, right? So once price takes a liquidity in that 50% region, right? But also we do something like this. We just simply do something like this. Yeah, something like this. Take out from you strong high to the weak low. So something like this. The market 50%. Once price comes above it, and then what? It takes out an inducement and then gives you that confirmation. That's a sell. So if maybe you look at this inducement and give maybe a sell confirmation, maybe you're taking the sell, maybe for a short sell, whatever, right? But 50% helps you in scenarios where price doesn't come to the overall low. So this thing will make more sense when you backtest it. Remember the ABC pattern. Don't forget ABC pattern. And this is it. Right? Don't forget that ABC pattern, which I taught you guys. Don't forget it. The ABC pattern, which is what? Strong low, inducement low, and then what? Original mitigation. Don't forget this. Strong low, inducement low, and what? The original will drop to what? To take your order and then what? Rally to the upside, right? So this is ending this call. If you got something, just type I got something, I got something, I got something, right? So see you guys in tomorrow's teaching. Have a wonderful day. Cheers and God bless.